there's $100 in your bank account right now. Where did it come from? You probably think your employer deposited it. Before that, their client paid them. Before that, someone else earned it. The money just moved around, right? Wrong. That money didn't exist until the moment someone borrowed it into reality. And the system that makes this possible is so strange, so counterintuitive, that most people refuse to believe it even after you explain it to them. This isn't a conspiracy theory. It's just how banks work. And once you see it, you can't unsee it. Let's start with what you were probably taught in school. Banks take deposits from savers. Then they lend that money to borrowers. They're middlemen, matchmakers between people who have money and people who need it. They make a profit on the spread between what they pay depositors and what they charge borrowers. Simple, honest, boring. Except that's not what happens. In 2014, the Bank of England published a paper with a sentence so blunt it shocked even people inside finance. Quote, "Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits." Read that again. Lending creates deposits. The money doesn't exist first. The loan creates it. Here's how it actually works. You walk into a bank. You want to borrow $10,000 to buy a car. The bank reviews your income, your credit score, decides you're good for it. They approve the loan. Now here's the part that breaks people's brains. The bank doesn't go into a vault and pull out $10,000. They don't call up their depositors and ask permission to lend their savings. They don't check if they have enough cash on hand. They just type $10,000 into your account. That's it. The money didn't exist 1 second ago. Now it does. You can spend it. It's real. The car dealership will accept it. But 60 seconds earlier, that money was nowhere. Not in a vault, not in someone else's account, nowhere. The bank created it with a keyboard, and you now owe them $10,000 plus interest. Now you might be thinking, wait, there have to be rules. There have to be limits. Banks can't just create infinite money or the whole system would explode. You're right. There are limits, but they're not what you think. Banks don't need to have your $10,000 sitting in deposits before they lend it to you. What they need is a fraction of it. In the US, that fraction is about 10%. It used to be exactly 10%. Now it's technically zero since 2020, but let's use 10% because it makes the math easier to follow. So, if the bank has $1,000 in reserves, they can create $10,000 in new loans. That $10,000 gets deposited somewhere, maybe in another bank. That bank now has a new deposit. 10% of that, $1,000, counts as reserves, so they can now lend out $9,000. That $9,000 gets deposited. Another bank can lend out $8,100, and on and on. 1,000 real dollars turns into over $90,000 in total loans by the time the chain runs out. This is called fractional reserve banking, and it means that most of the money in the economy isn't cash, it's debt, it's promises, it's numbers in a database that represent loans someone hasn't paid back yet. In the US right now, there's about $2 trillion in physical cash, but there's over $20 trillion in the banking system. That gap? That's money created by loans. So why does this work? Because of trust. You trust that when you go to the ATM, cash will come out. You trust that your $100 will still be $100 tomorrow. You trust that the bank isn't lying when they say your balance is your balance. And most of the time, that trust holds. Most of the time, only a small percentage of people want their cash on the same day. Most of the time, the system hums along fine. Money gets created through loans, it circulates, it gets paid back, new loans get made. But sometimes the trust breaks. In 2008, a bank called Washington Mutual had $307 billion in assets. It was the 6th largest bank in the United States. In September of that year, customers started hearing rumors that the bank might fail, so they did the rational thing. They went to pull their money out. Over the course of 10 days, customers withdrew $16.7 billion. The bank didn't have it, not in cash, Most of it existed as loans, as mortgages, as numbers tied up in assets that couldn't be sold fast enough. On September 25th, the government seized the bank. It was the largest bank failure in American history. Washington Mutual didn't collapse because it ran out of money. It collapsed because too many people tried to turn their digital numbers into physical cash at the same time. This is called a bank run, and it's the Achilles heel of the whole system, because if everyone asks for their money at once, the truth comes out. It's not all there. It never was. Now, governments know this. That's why they created deposit insurance. In the US, the FDIC insures deposits up to $250,000. The idea is to stop bank runs before they start. If you know the government will cover your money, you won't panic and withdraw it. And that works, mostly. But here's the twist. The FDIC doesn't have enough money to cover all insured deposits either, not even close. As of 2023, the FDIC had about $128 billion in its insurance fund. Total insured deposits in the US, over $10 trillion. The FDIC could cover roughly 1% of insured deposits if multiple large banks failed at once. So the insurance itself runs on trust. Trust that the government would step in. Trust that the Federal Reserve would print money if it had to. Trust that the panic would stop before the math caught up. This is the system. Money is created when banks make loans. Those loans become deposits. Those deposits allow more loans. The cycle continues as long as people keep borrowing and keep trusting. When trust breaks, the cycle reverses. Loans default, banks pull back, money stops being created. In extreme cases, money disappears. That's what a financial crisis actually is. Not a crash in stock prices, not a housing bubble popping. Those are symptoms. The crisis is the moment when the system of creating money out of thin air stops working because nobody trusts it anymore. And when that happens, governments and central banks have one move: create even more money to replace the trust. They did it in 2008, they did it in 2020. They'll do it again. So here's the question you're left with. If money is mostly just debt, if it's created by loans and backed by trust, if the system only works because we all agree to believe in it at the same time, what happens when that agreement starts to crack? You don't have to answer that now, but you might want to think about it the next time you check your bank balance and assume that number is real.